transparency in pricing is a problem, the liquidity in secondary market is a problem. I'm going to raise a little bit of controversy here, Aaron. I know, look, data is really important and everyone wants data. The real question is, do you actually pay attention to the data? Before, we've resisted SPVs, and the only exception we'll make these days will be a 0-0 SPV, single layer. So it has to be
Smart.
Just 1 degree of separation from the issuing company.
Hey everybody, welcome to Secondary Link's Venture Voices podcast. With me today, I got a very special guest, Karim Nurani, Chief Strategy Officer at Linqto. It's a pre-IPO stock brokerage focused on serving self-directed, accredited investors. Karim, thanks for coming in and talking with us. So if you could, just to kick us off, could you give us like a 60-second introduction to Linqto?
Yeah, wonderful. Thank you, Aaron. Thanks for having me today. Linqto is a financial marketplace platform. We created this company try to understand the needs of accredited investors to be able to easily point, click, and invest into private companies. And therefore, we created this financial marketplace platform. On the one side, you have the products, which are shares of private companies. On the other side, you have investors who can go in and quickly build their own portfolio of private companies that they would like to choose. We'd like to say it's almost like allowing an investor to be their own VC and determine what they'd like to invest in segments or categories of private companies.
Oh, that's awesome. So you guys are kind of both technology company plus financial marketplace. Is that fair? You have a lot of great technology.
I think that is part of the secret sauce there, because it's allowing what's not been possible before, where you can quickly access and invest into private companies. This is completely built on a technology platform that allows the efficiency of it, of private investing. And where we want to be is the Nasdaq or Robinhood of private companies moving forward. So you can go and invest and trade it.
Oh, that's awesome. Okay, so this podcast, of course, is all about the secondary market, right? And in particular, pre-IPO stocks. So I got a number of questions here. It sounds like you're well positioned to give some opinions here. So one, just how do you go about it deciding which pre-IPO stocks to purchase or kind of make available, right, to your guys' investors?
Yeah, that's not an easy feat. So I think what we have to do is be a little bit agnostic, because both you and I, Aaron, and if we put 10 investors in the room and give them a choice of stock products or company products, everyone would have a different decision of what they'd like to invest in. So we have to be agnostic in terms of the company name, but we have to look at the verticals that exist, perhaps the verticals that are getting some traction, and the verticals that we think that are going to make a difference. So obviously, we do a lot of research into the potential sectors that are going to be attractive to investors. As an example, we started looking at space, 2.5, 3 years ago, when we thought, okay, this might be a sector that's opening up. And then we started looking at AI into AI companies after that. Prior to that, in 2019 and 2020, obviously, we were looking at blockchain and fintech. So being careful about understanding the sectors that may be emerging with the new technologies, and looking at what the large VCs, Kleiner Perkins, M13s, and Sequoia may be investing in, gives us an indication of companies that might be interesting to invest in for our investors.
That's great. That's very interesting. So then once you decide or kind of settle on the companies that you're gonna look at, do you because getting data, I have a hard time getting data on the companies itself, right? I mean, it's private stock, so this is not like publicly traded information or public information. Do you guys kind of put together research or market data for your customers, and if you do, like, how do you get that data?
Yeah. So I'm going to raise a little bit of controversy here, Aaron. I know, look, data is really important, and everyone wants data. Everyone says, hey, how can I make decisions without data? And the real question is, do you actually pay attention to the data? And so we're familiar with lots of people who make investments in public companies, and ask 10 of your investors whether they actually read the 10K of the company that they were investing in before they invested.
Right.
And in most cases, the answer is they probably haven't. They've been influenced by the talking heads, the CNBCs, and various financial analysts. So when we look at private companies, obviously we don't have the data that's available internally to the company's executives, but we'll try to look at the extenuating circumstances. Is it a company in a spot that is trending well and positively? Have they made any announcements of their potential returns or sales, gross revenues? Have they filed for patents? Have they got grievances that have been exposed by their employees? We'll look at the careers page. We'll look at how the transactions, how the career trajectory looks like. So we'll try and access whatever is publicly available and then make an assessment using that data, as well as what kind of investors have invested in the company before. Now, just keeping in mind that we invest in companies that are medium to late stage, so primarily unicorn companies, $1 billion plus valuation. And so, yeah.
So that, I mean, I find that those companies, there's a lot of data in the media, right? It's actually surprising. I got to be honest. Like, I find it interesting. There's more data out there for folks to do research on, to your point, if they choose to look for it, right? And kind of the public sphere for these later stage companies, to your point, like the companies that you mentioned, these unicorn kind of $1 billion plus type businesses. I mean, would you recommend if investors like were coming into Linqto or kind of through other mediums, that they tap into those types of sources and kind of make an effort if they want to do research to use these kind of public sources for data and research?
Yeah, I think, I have to clarify just for your audience here is like, I'm not giving anyone financial advice. I'm not asking you to invest anything that we have on our platform. I'm just sort of educating you on what needs to be done. So I'm putting that clarification on this podcast here. But absolutely do your own research. I mean, look at the companies that are available to you that you want to invest in, the sectors that they're investing in. And then look at the publicly available information. We do have on our website access to our users for CB Insights. So you can take a look at the data that's provided by CB Insights if you're a user on our platform. But if you have access to PitchBook or various other publications, you should definitely take a look at that. And Aaron, I've got to say to you, you made a very good point. If you are interested, if an investor is interested in a particular company, they can find various access points to information. I know investors that are actually, and we do this as well, is actually calling employees of companies and seeing how they do, taking demos of the product if it's a SaaS company, looking at what their customers are saying, and actually speaking with potential customers. So depending on how much research you want to do, you can do a lot on your own.
That's really interesting. Very interesting. Okay, maybe we could talk a little bit about your guys' like trading process. So this is a little bit of the block and tackling. But when you guys, so you've now decided that you're going to take a position or in a particular pre-IPO stock, right? How do you guys go about actually going into the marketplace and buying that? Do you buy directly from the company? Do you go to other VCs or buy into SPVs? Like, how exactly do you get the exposure?
Yeah, all of those that you've mentioned are access points.
Okay.
So depending on what the company issuer's policy is on the options and shares in the secondary market, the access points vary. So a lot of companies, perhaps, obviously all of these companies have been invested into by VCs and early stage funds, probably in the Series A, Series B, or Series C. And if you look at the trajectory and lifespan of those funds and a Series A level, they're probably approaching term life, which means they're probably at 7, 8, 9 years old. And some of those VC companies are looking to get some cash back into their fund. And so we'll look at those as opportunities for us to buy those shares. We'll look at employees who might want to offload some shares, founders, advisors. They may have been issued some shares as well in the beginning. And then there are obviously the layered SPVs, which special purpose vehicles, where other investors have bought into the company through a different fund, and they might be trying to offload some of that. And then obviously there are brokers in the market that employees call themselves, looking for themselves to find liquidity and sell shares. So we'll tap into these various aspects as well as talk to employees of companies that might be looking for liquidity.
Okay, that's very interesting. And then do you find that any particular, I'll call it channel or medium, is best to kind of optimize pricing? Is it kind of that using brokers to get price discovery, or kind of your existing relationships? Like, where do you find that kind of the best price exists if you're coming in at from a more, I would say, like an institutional level? Like, you guys are obviously an institution, so you're probably purchasing large lots, right?
Yeah, we're what you would call dynamic pricing, which means we'll buy small lots
Okay.
because we're using our capital, and then we cater to the retail investors. So we have to find out what the interest is on the retail investor side for these particular companies. So we'll go to market into a particular company, identify a seller, buy some of the stocks, and then allow other investors to invest in the company. And dynamic pricing allows us to do a couple of different things. One is take advantage of market conditions and trends. If the company's valuation is going up, we'll continue to buy, and we'll see the value of the shares go up. If it's going down, some people say, well, that's a tailwind. In other cases, it's actually an opportunistic buy for us. But sometimes we're left holding something that doesn't do so well.
Okay.
Pricing is very opaque. It's determined by what the strike price is, what the 409k of the company, what they issued the stock at to their employees or people who hold stock.
Right.
So they might be reluctant to sell. But if there's a compression in the public equities market, that is also reflected in the secondaries market. And so there's a mismatch of company pricing, sellers and buyers, which takes 3 to 9 months to sort of equalize
Right.
for investors and sellers.
Right. Yeah. I mean, that price discovery, I mean, I can speak for my own business. I spend a lot of time on price discovery. I find that, to your point, there's a lot of inefficiency right in the market. So kind of dialing in on that is important. But I got to tell you that what you said there and kind of how you guys run your business with, I use the word warehousing, right? So buying
Yeah.
shares in the market and then kind of warehousing them. There's different names for that kind of in the public market, right? But that's such an interesting business. And I know of one other firm that's doing something similar, which is they're like very old, kind of more old school, traditional, not, I think, technology focused like you guys are with your platform. But it's such an interesting business model. Like, when you guys bring on those positions, do you hedge it? Like, how do you manage that risk? Do you hedge it? Do you use your derivatives or kind of swaps, or do you're just long exposure and you kind of have to think about how you accept that?
Yeah, no. So that's a great question. I mean, it's use our own cash for it, so we're taking the risk, and it is our capital risk. So
Okay.
sometimes we're left holding the bag if the environment changes quickly and a particular company falls out of flavor,
Uh-huh.
then it's our investment, and we'll lose money on it. Um,
Got it.
but I think what it allows people and investors to realize is that we're putting our money first, and if we are holding the stock, and if you are, as an investor, do not want to invest in, that's okay with us, because we made a decision based on what we thought the company would do. And so
Okay.
eventually, hopefully, it'll go in the right direction.
Oh, that's really interesting. Okay, that's very interesting. That's actually fascinating to me, right? So because you're bullish on the position initially, and that's a way of managing the risk. That's Very interesting. Okay, listen, let's maybe switch gears just a little bit, because one thing I talk about constantly with people, both kind of, I would call it industry experts kind of in this pre-IPO stock, ecosystem, and also investors, is SPVs, right? So you mentioned that earlier, that you guys do consider kind of buying into SPVs. What are your thoughts on kind of like a single layer SPV versus a double layer SPV? Do you guys have like strong opinions or preferences around that? Maybe we could start there, and then also just tell me a little, maybe just give some thoughts on how you do due diligence or underwriting around, if you think an SPV is acceptable to invest into or not.
Yeah, Aaron, I'm hoping you can share some of your experiences with me and the audience as well on that, because it is not an easy decision to make. I mean, we launched our company in 2020, and we only started doing SPVs in the last 6 months. Prior to that, we were buying shares directly, so we'd be on the cap table of the companies that we were investing in.
Okay.
And we resisted SPVs. It's because of the reasons you mentioned. Who are the principals in the SPVs? Now, a double layer or triple layer SPV, there are 2 or 3 different things you have to worry about. One is the cost. So most of you may have heard 2 and 20. SPVs will carry 2 and 20, or 1 and 15, or 3 and 30. And the first number actually means a management fee, which is accumulated every year. So 2 and 20 would mean 2% every year is a management fee of the SPV. And 20% would relate to the carry, which means as the company finds liquidity that you have created an SPV for, the promoters of that SPV will first shave off the 20% from their sales and then distribute the remaining 80% to the LPs or the other investors on the SPV. So that's one thing to be careful about. So a single layer SPV is, the promoters. It's a company or a bunch of investors that have said, hey, we've created an SPV to hold the assets or the shares of a particular company in this SPV. Mm-hmm. That SPV may be directly on the cap table of the issuing company.
Right.
Now, a second layer SPV would be someone who's created a secondary SPV that sits on top of the first SPV with different investors. So you're there now. There's a layered structure of pricing and management and carry that you have to be aware of. And some of the hesitancies there, as you start to see a divergence or a spread between, or the distance between being on the cap table directly and the layered SPV, the question then really becomes, who owns the SPV? Who's responsible for the management? Have you done the due diligence on the investors on those various SPVs? Do you know them? And then that's just the first stage. And then the second stage will be in terms of liquidation. As a company goes through liquidation, whether it's an IPO or M&A, how do those SPV holders get paid?
Right.
After the fees are deducted, then who gets paid first? And then do you then eventually get paid? And then what are your limitations or your restrictions as an LP in that SPV? And what are your recourses in case you don't get paid? So is the SPV held onshore, which is the US? Is it in Bahamas? Is it in Europe? Is it in a tax-free zone? These are all questions that you have to worry about on SPVs, and depending on how many layers exist.
Yeah, I mean, that to me, I agree with everything you say. And I think it kind of almost tips your hat to, like, if you're an investor and you want to get into the space, you should have an expert kind of working on your behalf, right? So like a firm like Linqto that's doing that due diligence and saying, hey, we think these guys kind of meet the mark to be available for sale on our platform, is one form of due diligence. There's like, and then there's like stuff, to your point, what I do. I'm an investment advisor, right? So I have a fiduciary responsibility to make sure that meets that SPV that we would invest into is up to snuff, right? With a particular investment. So that's smart. Like, I think, like, it's not for the faint of heart, in my opinion, right? Like, you got to know, you have to do due diligence. Yeah, you have to know who your counterparty is, because I think there's very real risk, like you pointed out. But that maybe the one other thing I would ask you, about, and this I've been spending I personally have been spending a lot of time on this particular area, but you talked a lot about the SPV fees, right? And when I reach out and I get offers back, and I use brokers, right? So I kind of reach out
Yep.
to multiple brokers and I get offers back. None of these are like the same. The offers come in all different shapes and sizes and forms and different fee levels, et cetera, right? So I almost have to go through this exercise of normalizing all of that, right? I mean, do you guys have specific, like if you get a 0 SPV, that's kind of the easiest. And if there's like an upfront one-time fee, that's like the easiest to digest, right? But then if you get something that's got a much lower price per share, but then perhaps has like a 10 or 20% carry on that, do you guys have like a model or a formula on how you go about normalizing that? Or maybe you only consider like 0 SPVs, or give me some thoughts around just how you look at your different offers and how you decide which one's best.
Yeah. You know, as I said before, we've resisted SPVs, and the only exception we'll make these days will be a 0 SPV single layer. So it has to be
Smart.
just 1 degree of separation from the issuing company. So no management fees and no carry. That does mean, though, oftentimes, because everybody wants to make some money, and everyone has to make a little bit of money. And so what happens is the creator of the SPV says it's a 0 SPV, but there'll be an upfront fee for between 3 and 8% or 9%. So that would be the pricing that they are making money on. So, as an example, they're buying a share for $10, they'll add their percentage on it, depending on the company and depending on the size that you're buying. It's 3 to 9 or 3 to 10%. I mean, that's just all over the place. But it's still
Right.
0, which means on exit, you don't have to worry about the carry, or depending
Right.
on how long it is to exit, you don't have to worry about the management fee.
Right. Yeah. Okay. Gotcha. That's actually, I think, a smart risk management approach, right? I'm in the same boat. I'll take offers and kind of double layer SPVs or SPVs that have management fee or carry, but man, that's the sweet spot. If you can get a 0 with a single layer, that's kind of risk off, or much more risk off, in my opinion. But
Yeah.
okay. Last question I have for Karim, is a lot of my investors have been coming back and asking about how I mark the positions in the funds that I run, right? And especially now, like the pre-IPO, stock asset class, these things are coming back. A lot of these companies are starting to appreciate, and something will hit the news, and they'll call me up and say, "Hey, are you marking up the position, right, in the fund?" So, how do you guys go about thinking about marking position? Do you do it every month? Do you do it is it like periodically? Is it just say, "Hey, when there's a primary round"? Do you have some kind of like secondary market approach? Like, what's your thought process around marking the portfolio, whether it's up or down?
Interesting observation there, Aaron. So, as you know, I mentioned earlier, we're very dynamic on pricing. So we buy small lots, and we're not left holding a big bag at a certain price. So what we've seen is actually we look at the portfolio on a regular basis, and if there's something that we bought some time ago that we're still holding, and I think the more valuable part of this conversation is what we've seen that has happened since 2022
Right.
to now, where
Sure.
there's been a compression, and we've actually had to mark down a lot of the prices.
Okay.
Marking up, what happens in this case is we go to market, buy something for 10, we're back in market, buying something, and as the prices start to normalize, generally for good companies, that's going up. And so let's say we go to market 3 months later, and we're paying 12 or 20% markup on the last round. We're marking that up appropriately. So because what we don't do is we don't take a carry, and what we do is we get our money up front. So we mark it up with our markup, and then have the investors buy at that price. And so if you're an investor that came in and bought it, let's say in January at $10, we've gone back to market and bought it at $12. You're, as a new investor or a returning investor, you're going to pay up on the markup price, but it also means you've already made your money on the first buy you made.
Position. Right.
Your first position. Yeah.
Yeah, I mean, there's no right answer on this, right? At least not that I can see. But to me, it's becoming increasingly a topic of discussion with my investors, like existing investors. Like they want to see the position go up. If they see something in Bloomberg, right, they want to see it
Yeah,
reflected in their statement, like almost
yeah,
immediately, right? So,
yeah.
which I understand, and so there's some interesting nuance there, but
Well, let me
there
ask you
also
this.
is, yeah. Please.
Let me ask you this: are they just as anxious to see a down round?
No, well, I mean, that's the racket, right? So, I mean, as the fiduciary and the fund manager, I'm like, look, we have a pricing policy. We follow the
Yeah,
pricing policy, right? That's like my
yeah.
response, which is the right answer, I suppose. I don't know if there's a right pricing policy. I think the key is you just have a pricing policy and you follow it, right? I think that's probably the most important thing. So maybe it falls on my shoulder to just articulate that well, I suppose, what that pricing policy is. So there's some good transparency there, but. Yeah, it's very interesting. My gut, I got to tell you, Karim, like my gut is to just use like an 8 view, for example, right? Those guys are great. Third party pricing, secondary pricing company. It's just like when I used to run ETFs and we would use a third party pricing source to mark the portfolio every day. Same thing, right? In the private markets, but there's just a lot of dislocation these days. Like, there's been a couple of companies that have come out and did primary rounds, and the secondary market was way off, like up or down, right? So
Yeah, yeah.
it's interesting. It's very interesting. Some of this, it's almost getting a little opportunistic out there, right? If you're an institutional buyer in some of these names. So that's great. Anything else that you want to hit on or kind of cover off on in kind of the
I mean,
secondary markets
uh,
that you think are important?
yeah. I mean, Aaron. I mean, thank you so much for the time here this morning, talking about the basics of investing into secondary markets. That's a very topical environment today. I think the next time, perhaps we should talk a little bit more about what's happening with the issuers and how they're pricing their secondary market and how they're restricting some of their employees in accessing the secondary market. And then, as you say, the transparency in pricing is a problem. The liquidity in secondary market is a problem because
Right.
it's liquid to a certain few parties, the institutional investors, as well as some of the larger type investors. But this is what we're trying to change. What we're trying to change is the access of private equity to the ordinary retail investor. And how do we do that effectively if we don't have clear, transparent policies and pricing that private companies should get on board with? I mean, that's thematically a big issue, and I think this is something that we have to talk about a little bit more deeply. But having said that, what are you seeing in the market, Aaron, in that particular aspect of transparency by the private companies and the issuers and the restrictions that they put around transference of private shares?
Yeah, so I would say two trends come to mind for me. One is I am seeing more companies go to like a structured tender offer, right? Whether
Yeah,
that's every 6 months or every year. That seems like more and more and more companies are kind of moving in that direction. And then also too, I think it's this emergence of SPVs, right? I think more companies I'm seeing are letting less people on their cap table, right? So then those kind of like special few that have access, to these tenders or to these rounds that they're doing, it's kind of now almost becoming common. I think much more common with a lot of names that the liquidity is in the SPV, which I've started to describe to my investors and clients as ADRs. It's like the private market version of an ADR, right? So
yeah,
no one kind of ever really thinks about, oh, I'm going to buy Volkswagen stock through an ADR. It's Volkswagen stock, right? It's just the kind of the pass through vehicle that I'm going to get to the actual stock. And that's how I've been describing SPVs to investors. And that seems to be resonating. So those are the two trends. I do hope that more folks, more companies, more issuers, right, go with these structured tender offerings. I think it's very thoughtful. It adds good price discovery. It helps with employees, as you mentioned earlier, right? Get liquidity. And it also, I think, I see a lot of companies, their management team kind of manages the valuation. Like,
yeah.
and it's like Andrew's doing this. There's a couple other that are kind of doing something similar, like really managing that valuation and maybe not maxing it out. So they're almost preparing for, bad times ahead, perhaps, right, where they can still continue to show, an increase in valuation even through kind of a rough market cycle. So, yeah, those are the two trends I'd say I've been seeing right currently. This is kind of the structured tenders. I see more companies doing that, and then this innovation with SPV. But listen, I would say this though. I think just to pat you on the back, I think what you guys are doing is so interesting and cool at Linqto, right? To me, what it's a sign, and I've been around a little bit, right? It's a sign of like this asset class with these companies staying private for longer. It's like a proper asset class now. And you get really smart people like you guys coming in and innovating, right? To me, it's a sign of a maturing marketplace, right? And I think that's so great about this. So, hats off to what you guys are doing over at Linqto. I think it's pretty special.
Thank you so much, Aaron. I really enjoyed this conversation, and I appreciate the kind words. I mean, it's not easy, and I think there are a lot of us who are in the market who know that this needs to change, so that people can take control of their investment strategy and not be left out, so to speak. So we just need more private companies who are out there saying, "Hey, you know what? We want more of you investors, because why wait till get to the public markets? Take advantage of what we have now, it's an interesting model, and we just need more people involved." So thank you for doing your part there, Aaron.
Well, cheers. Same to you, man. Same to you. So listen, thank you very much for joining today. It was a pleasure to spend time with you, and hopefully we'll do this again soon.
Thank you so much.
Okay, cheers.